Hello, Asian guy here again. You're watching Financial Updates. Today we're diving into urgent warning. A 55B silver sell-off could crush markets. Brace yourself, because what you're about to hear isn't hype. It's not fear-mongering, it's happening right now, and it could affect your wallet, retirement, and everyday financial security. In the past few weeks, silver, a market many thought was just climbing higher, suddenly collapsed. Prices plunged nearly 9% in a single session, the steepest drop in years, after traders were forced to dump positions following margin hikes. And if you think silver is just a nice-to-have metal that only matters to jewelers, think again. Silver underpins everything from solar panels to electric vehicles and high-tech manufacturing. When it crashes, it ripples through markets faster than most people realize. Before we go further, though, if you want real financial updates that matter to your life and not just market chatter, make sure you subscribe and turn on notifications so you don't miss critical updates like this. So here's the question. Could a roughly $55 billion silver sell-off, forced and sudden, trigger a broader market correction that hits stocks, bonds, and everyday investors' portfolios? Stick with me, because by the end of this video, you'll understand why the sell-off isn't random, what's really driving it, and what it means for your money in 2026. Let's start at the beginning. Why silver was surging. And what changed? Silver had one of the most dramatic rallies in decades in 2025. Prices more than doubled from the start of the year, climbing from around $30 to above $79 an ounce, driven by strong demand, inflation fears, and expectations of easier monetary policy. Investors poured into silver not just as a commodity, but as a hedge against inflation and financial uncertainty. Manufacturers were scrambling to buy physical supply because silver is essential in solar energy, EVs, and electronics. But then something striking happened. In late December, the market experienced one of its most violent sell-offs in years. Silver futures dropped more than 8% in a single day, the biggest plunge in nearly 5 years. Why? Because the Chicago Mercantile Exchange raised margin requirements, meaning traders had to put up more cash just to keep their positions open. That forced a wave of forced selling. To put it simply, it wasn't just investors choosing to sell. Many were forced to liquidate positions because they couldn't meet the new cash requirements. That's the price action equivalent of a $55 billion avalanche rolling down a financial mountain, hitting everything in its path. Which brings us to the big question. Is this just a temporary drop? Or is this the opening move of a broader market unwind? The 55B sell-off. What it really means. When a major market like silver moves this fast and this hard, it's not just a blip. Sharp sell-offs like this often signal deeper stress, not just in metals, but across broader markets. Think about it this way. Silver isn't a standalone isolated asset. It's tied into industrial demand expectations for central bank policy, inflation, hedging behavior, and crucially, investor confidence. And when confidence shifts, money doesn't just move, it races for the exits. This rapid liquidation can trigger dominoes. Forced selling in futures triggers price drops, spark volatility in related assets. Volatility pushes leveraged funds and swing traders out. And suddenly, stocks, bonds, and commodities all feel pressure. This is how market corrections spread faster than most people expect. By the end of December 2025, silver had carved out one of the sharpest reversals in recent memory, and markets felt it. Stocks, bonds, and other risk assets didn't move in isolation afterward. That's the signal smart money watches, not headlines. Now let's break down exactly why this happened, and why it's more than just a market hiccup. Margin hikes trigger force liquidations. First, the CME raised margin requirements on silver futures, essentially raising the cost of holding positions. And this isn't new. Exchanges sometimes do this to reduce risk in times of extreme volatility. But the timing was brutal. Riders like hedge funds and leveraged traders were pushed into selling positions fast. When forced selling hits hard enough, prices don't just fall, they gap down as stop-loss orders cascade, liquidity dries up, and positions are closed automatically. Suddenly, what looks like a sell-off becomes a chain reaction. That's how the market wiped out nearly $50 billion or more in roughly days, not months, worth of silver positions. Silver's volatility is much higher than most people realized. You might think of dollar cost averaging or buy and hold strategies when you hear silver, but in 2025, silver started behaving more like a risk asset with gravity, meaning when it moves fast. In a recent session, prices swung more than 14% intraday, one of the most turbulent days for silver in years. That tells us something important. Silver's trading dynamics are fragile, not like gold, which moves smoothly on fundamentals, but like a thinly traded commodity that can be whipped around by big money flows. and that makes sharp sell-offs more likely, not less. China's strategic silver controls add a geopolitical twist. Here's the part that most retail investors aren't talking about, and it's huge. China is rolling out new export licensing rules that control more than 60-70% of global refined silver trade. This isn't a minor trade restriction. It fundamentally changes the global supply landscape. Chinese supply used to flow freely to global markets. Now it requires government approval, and that reduces available global inventory. Reduced global supply, plus volatile markets, fire even bigger price swings. This means two things for 2026. If supply truly tightens, prices could spike again. But geopolitically driven constraints also increase risk, because markets don't like uncertainty. A single shift in export policy can spark rapid moves, both up and down. And in this case, what we're seeing so far is the downside first. So why should you care? What this means for your money. All right, let's bring this home. You might be sitting there thinking, fine, silver sold off, but why does it matter to me? Here's the bottom line. When a market as big and interconnected as silver sees a forced sell-off of this magnitude, it doesn't stay in a vacuum. This affects mining stocks, commodities indices, inflation hedges, industrial metals pricing, and even risk appetite across global markets. In fact, markets overall felt the stress. After silver's plunge, major indices like the Dow and S&P saw broader weakness. And gold, though still elevated, didn't escape the pullback. If silver, once expected to be a hedge, begins to drag markets instead of support them, that's a red flag for risk assets everywhere. And here's the kicker. Major banks and analysts are now questioning whether the silver rally has already exhausted its momentum, even calling parts of it bubble-like. That doesn't mean crash tomorrow. But it does mean the market is entering a new regime of volatility, where swings are bigger, faster, and less predictable than before. Why this sell-off happened, and why it was huge. Two big factors drove the sharp downturn. Margin hikes forced traders to liquidate positions. The exchange where most silver futures trade, the CME Group, raised margin requirements on silver contracts. That means traders needed more cash to hold the same positions they had yesterday. Margins for the March 2026 silver contract jumped from around $22,000 to about $25,000, nearly a 14% hike. That doesn't sound dramatic until you understand what margin is. When traders borrow to hold a position, a margin hike is like a bank suddenly calling in part of a loan. If traders can't meet the new requirement, their position gets force sold. That's exactly what happened. Tens of thousands of long positions were unwound automatically, creating a cascade of selling that slammed prices sharply in just one session. This wasn't just traders choosing to cash out. The exchange literally forced the action by increasing the cost to stay in the trade. Extreme volatility made liquidations. Worse, silver wasn't just falling, it was bouncing. In some sessions, prices swung more than 10%, even up to 14% intraday. That kind of volatility spooks markets, especially leveraged ones. Think about it like this. If prices wiggle around a little, cool. If they swing wildly, stop-loss orders trigger, algorithms sell, and suddenly everything becomes self-reinforcing. That's what turned a big sell-off into something nervier and faster than a typical pullback. This kind of behavior is not normal for a commodity that's supposed to be safe haven like gold. But here's the twist. Silver isn't gold. It has huge industrial demand that makes it much more sensitive to sentiment and leverage trading. The silver sell-off isn't over, but the story is splitting. Here's where it gets interesting. Even as prices slumped, some analysts are warning that silver's overall trend could still be intact in 2026, albeit with major volatility. At the same time, others are calling the current move more than a correction, possibly echoing bubble-like characteristics. Let's look at both angles. Bullish side, structural demand. Still real. Despite the sell-off, long-term supply and demand fundamentals aren't gone. Silver is a critical metal, used in solar panels, essential in electric vehicles, required in data centers and electronics, increasingly viewed as a hedge against macro risk. And inventories have been tight. COMEX and global vault stocks have dropped sharply over the past year. That's why some analysts believe silver's rally still has underlying structural support, meaning the sell-off could be a healthy consolidation before the next leg up. In fact, surveys show that a majority, 57% of retail investors, still expect silver above $100 SAWs in 2026, even after the recent volatility. So the bullish thesis isn't gone, it's just more tempered and realistic. Bearish side, bubble risks and momentum cracks. But here's the cautionary note. Silver's move earlier this year was extreme, so extreme that some financial models now suggest bubble behavior. similar to other historical commodity surges. And after a massive run, the sudden forced selling isn't just a correction. It can signal that speculators are already on the exit ramp. Combine that with a potential shift away from high leverage, and you get a scenario where prices stay lower, volatility stays higher, sentiment turns cautious. That's not a crash, but it is a regime shift from runaway rally to range-bound uncertainty. Is this a one-off sell-off or something broader? Here's where the markets diverge sharply. Some analysts say the sell-off was largely technical, driven by thin year-end liquidity, profit-taking, and margin changes, and that the longer-term thesis remains intact. Others warn that comparisons to past structural bubbles are not off the table, especially given unusual price ratios and intense leverage. This divergence in views matters because markets don't just trend, they oscillate between fear and greed. And when a big sell-off hits right after a huge rally, it can take months for the market to decide which direction it wants to go next, which means 2026 is far from written in stone. So what does this mean for your money in 2026? Okay, here's the part that matters most to you. This isn't abstract market noise. It's affecting real portfolios, real retirement accounts, and real consumer sentiment. Let's break down what this means in everyday terms. If you bought silver, near the top, you're likely underwater right now. That's not unusual after a volatility spike, but it means timing matters a lot more than most people think. Silver doesn't behave like a boring bond or a savings account. It's wild. And when markets move this fast, profits can evaporate just as quickly. If you're thinking about buying now, markets that correct sharply after big rallies tend to linger in uncertainty, not immediately bounce back. Some analysts see 2026 as a year of consolidation rather than a straight rally. If you're holding stocks or risk assets, this matters too, because when one major market gets whipped around by forced selling, risk sentiment overall erodes. This sell-off has already had rippling effects on mining stocks and broader indices. That's why many strategists urge investors to think holistically, not just bet on silver alone. The turning point for 2026. So here's the key takeaway. 2026 won't be defined by whether silver goes up or down. It will be shaped by how markets adapt to volatility, leverage, and structural real demand. There are three possible scenarios ahead. Scenario number one, silver stabilizes, consolidates, and then resumes a measured rally based on real supply-demand fundamentals. Scenario number two, the correction deepens first, potentially wiping out part of the recent rally before a genuine trend forms. Scenario number three, a new macro event like policy changes, rate decisions, or geopolitical shocks reshapes the direction entirely. Markets are always about probabilities, not certainties. And right now, we're in a probability pivot. 2026 scenarios, not one path, but three. Markets don't move in straight lines. They oscillate, they wobble, and they react to both psychology and real economics. Right now, silver is at a crossroads, and experts are seeing three major paths for 2026. Scenario number one, consolidation and slow retest. Some analysts believe the silver sell-off is not a crash, it's a consolidation. This means prices settle into a range instead of continuing straight down. Market experts point out that volatility around year-end, thin liquidity and profit-taking, is a known seasonal pattern, and that the long-term trend may still be supported by fundamentals. In this case, silver might trade sideways, bouncing between support and resistance levels, while investors wait for clarity on macroeconomic signals like U.S. interest rates and industrial demand strength. This might feel boring, but for disciplined investors, it's a time to plan strategically, not panic. Scenario number two, deeper correction before rebound. This is the cautious view shared by economists and seasoned traders. Even though silver has structural demand from solar, EVs, and industrial tech, prices may retrace further before stabilizing. Why? Because the speed and magnitude of the rally, followed by forced selling for margin changes, can exacerbate swings more than fundamentals alone would. Historically, when prices trade far above key support, like silver did above its breakout levels, markets usually test those support levels again before resuming an upward trajectory. Investors in this scenario should watch key price floors, like previous breakout points, because a slide below those could trigger more selling from risk managers and algorithmic funds. This isn't doom and gloom, it's simply market mechanics. Scenario number three, structural rebound, fueled by real demand. Now here's a bullish but realistic possibility. Silver's fundamentals haven't disappeared just because of a correction. Long-term supply deficits are real. Production cannot easily ramp up because much of the world's silver is a byproduct of other mining operations. Meanwhile, industrial demand, especially from renewable energy, AI infrastructure, and EVs, keeps growing. And here's a twist almost no one highlights in mainstream commentary. China is tightening control over its silver exports. a move that could create global supply bottlenecks and drive prices up again once volatility subsides. This kind of geopolitical shift doesn't show up in short-term technical charts. It shows up in real long-term supply dynamics. So if silver rebounds from a deeper drawdown and sustains higher lows, that could signal a resumption of the broader bull thesis, but only if markets prove they can absorb volatility without forced liquidations. Warning signals to watch in 2026. Here's where most investors go wrong. They watch prices instead of watching the signals driving prices. Pay attention to these key indicators: volatility and margin requirements. If exchanges like CME keep raising margin levels to curb risk, that's a sign the rally may be overstretched, not strengthening. Margins rising isn't neutral. It forces selling, dries liquidity, and amplifies price swings, silver versus other commodities. Right now, the silver to oil price ratio is at levels not seen in decades, with silver more expensive relative to oil than normal historical ranges. That signals distortion, not equilibrium, meaning markets could correct until price relationships normalize. This relative valuation isn't just trivia. It's a practical signal professional traders use to judge whether a market is overheated, retail sentiment versus institutional caution. Recent surveys show a strong majority of retail traders expect silver above $100 in 2026, even after the crash. That tells us one thing: fear of missing out, FOMO, remains strong, which is often a contrarian warning sign. Institutions, on the other hand, are much more cautious, advising range trading, strategic dips, and diversified exposure between silver and other assets. What this means for your money. Let's get specific, because you're watching this not for abstract drama, but for real concrete impact on your cash, savings, and investments. If you already hold silver, don't panic sell, but don't act like nothing has changed either. Sharp corrections often signal reset periods, not exits. A smart strategy here could be tighten stop losses, accumulate on dips, balance with other assets like gold or industrial metals. Because if silver does rebound based on fundamentals and supply dynamics, those who bought the dip could be in a stronger position. If you're thinking about buying. Now, this is where most people get hurt. Jumping in straight after a crash, without context, is one of the most common mistakes investors make. Instead, consider staggered buying, dollar cost averaging, watching key support levels, not just headlines, keeping silver exposure within a diversified portfolio. Because markets are unpredictable, but probabilities and risk management are real if you hold broader markets. Silver doesn't move in isolation. When precious metals switch from being safe havens to liquidity events, as we saw in the recent sell-off, risk sentiment across stocks and commodities shifts too. That means your equities, bonds, and even crypto could feel the ripple effects. Diversification isn't just a buzzword, it's protection. The one move almost everyone gets wrong. Here's the real lesson most investors miss. Assuming a correction equals a crash or a rally equals unstoppable growth. In real markets, both directions happen, often in clusters. Corrections can be healthy, rallies can be exhausted. And the markets that last are those that adapt, not those that assume they know the direction. Right now, the consensus, even among experts, is this: silver is entering a year of consolidation, volatility, and strategic repositioning, not simple bull runaway action. That means your best long-term edge is disciplined strategy, not hype or fear. Let's sum it up clearly. Silver's massive sell-off was triggered by margin hikes and forced selling, not random panic. Volatility is real and will stay elevated going into 2026. The market could consolidate, correct deeper, or resume structural moves higher, but nothing is guaranteed. Supply shortages and geopolitical policy shifts could drive prices long-term, but only if markets stabilize first. Your move shouldn't be emotional. It should be strategic, data-informed, and risk-aware. If you found this valuable, hit subscribe and turn on notifications, because markets like this don't move quietly, and you deserve updates that matter. Thanks for watching Financial Updates. I'll see you in the next deep dive.